Hello everyone, welcome back to the channel. In today's video, I'm breaking down my entire dividend stock portfolio company by company and explaining exactly why I've placed each one into its respective tier. These rankings are based on my conviction level, overall performance, long-term potential, and current market conditions. Let's dive in. The first company is Apple. Apple is still one of the best run companies in the world. Its ecosystem is second to none, and it has created a near impenetrable moat through hardware, services, and customer loyalty. I put it in the A tier instead of S tier because its valuation is on the higher side and its growth has matured a bit. Still, Apple generates monster free cash flow, rewards shareholders generously, and continues to innovate but at a slower pace. Colgate has global scale, but it's a slow mover. There's little innovation and the brand hasn't seen major reinvention in years. It's a defensive name, but with low growth and minimal excitement. I hold it for stability, not upside. This one is placed in the tier C. Texas Instruments produces analog semiconductors that go into everything, from industrial machines to consumer electronics. It's not a flashy chip stock, but it's ultra profitable, shareholder focused, and generates huge free cash flow. Cyclical by nature, but dependable over the long term. This one could go to a higher tier, but the increase in capital expenditure will hold it for a while until they build their mega factory. This one will be ranked in the tier B. ABBV makes the tier A because of its strong dividend and promising pipeline. While Humira is in decline due to biosimilars, the company next-gen drugs like Skyrizi and Rinvoq are picking up the slack. There's also growth potential from its neuroscience division and past acquisitions like Argen, a strong dividend payer with manageable risk. Automatic data processing may seem boring, but that's part of the appeal. It's a dominant player in payroll and HR software with incredibly sticky clients. In a volatile world, ADP offers consistent cash flow, margin expansion, and dependable dividend growth. It's the kind of business you can count on in both bull and bear markets. The company will go in the S tier. Nike is a global brand powerhouse, but recent earnings have shown margin pressure, inventory issues, slower international growth, and competition chipping away market share. I'm confident in the long-term vision, but near-term volatility and operational challenges keep it in the tier D for now. Pepsi's dual play on snacks and drinks gives it a defensive moat. The snack segment has been a growth driver, and the company continues to innovate. Not high growth, but consistent and reliable, which makes it a solid B tier hold. Starbucks has had a rough patch, which puts them in tier C. While the brand is strong, unionization pressures, international challenges, and management turnover have made it harder to project stable growth. As mentioned, this company will be in the tier C. It needs to show stronger execution. Kroger is a recession-resistant staple that benefits from consistent food demand. Their strong store footprint and growing digital presence give them a solid foundation, but razor-thin margins in the grocery business and fierce competition keep it in the B tier. Still, it's dependable and shareholder-friendly. Waste Management is a steady performer with essential service revenue that also belongs in the B tier. It's not flashy, but the trash business has high barriers to entry, good pricing power, and strong cash flows. They also make strides in renewable energy and recycling, which adds a future-facing angle to the business. Microsoft is simply everywhere, from mature in cloud computing to Office 365 and productivity to AI integration with OpenAI. It's consistently expanding its ecosystem and revenue streams. The company has one of the best balance sheets in the market and continues to reward shareholders with dividend increases and buybacks. It's hard to overstate how integral Microsoft is to global businesses' infrastructure. This company is an absolute S tier. Hershey's is a quiet compounding machine. Its brand is strong and it has pricing power that few others in food can match. While recent inflation, climate change, competition, and weight loss drugs have hurt margins, it continues to produce consistent earnings and dividend growth. This is a company that I put at the top of the consumer defensive category. To me, it's the best buy in the sector. This growing but also stable company will go in tier B. Alphabet, the parent company of Google, is an advertising juggernaut, but it's also much more. YouTube, Google Cloud, Android, Waymo, and massive AI development all fall under its umbrella. With tons of optionality and a fortress-like balance sheet, Google continues to innovate and dominate. Even with its size, it still posts double-digit revenue growth and commands serious pricing power. Alphabet is an obvious S tier. JP Chase is the best-run major bank in the world that goes in the A tier. Under Jamie Dimon's leadership, it becomes a model of stability and strength. The bank has strong capital ratios, a growing dividend, and a diverse business model that spans investment banking, consumer finance, and wealth management. It's a solid play on the US economy and financial sector. Home Depot is a leader in home improvement and has historically posted fantastic returns, but with higher interest rates and a slowdown in housing, short-term pressure remains. That said, it's still a cash machine with pricing power and a fantastic brand, placing this one in tier B. Visa is a critical part of the global financial system. It doesn't issue cards or lend money. It simply facilitates transaction, which makes it a low risk and high scalable. With incredibly high profit margins and strong global tailwinds from the cash to card trend, it continues to be one of my highest conviction holdings. Their global expansion into contactless payments and cross-border transaction is only fueling further growth. This holding is an automatic S tier for me. MasterCard, much like Visa, thrives on transaction volume. It benefits from the same digital payment megatrend, but has also been expanding into fintech infrastructure, B2B payments, and real-time transfers. Its strong balance sheet, aggressive innovation, and impressive return on capital makes it a must-own in this era of digital finance. MasterCard will go alongside Visa in the S tier. Procter & Gamble is one of the most consistent consumer staples around, but at today's valuation, it's not offering much growth. The dividend is secure, but I view it more of a bond replacement in my portfolio. I don't expect from this consumer staple to heavily innovate and increase their profit margin to crazy levels, but what I truly expect is the stability and peace of mind that this holding brings. For the slow growth and lack of innovation, this will go in the tier C. For realty income, I love the monthly dividend, but higher interest rates has been tough on REITs, and realty income has underperformed. Its tenant base is solid, but debt levels and rate sensitivity means growth will be slow unless macroeconomic conditions improve. Good thing is, high interest rates are not forever. Realty currently has a solid portfolio and they are expanding into new sectors. This one goes in tier C for the time being due to macroeconomic factors, which realty income doesn't control. Johnson & Johnson is a defensive healthcare giant with solid dividend history. It's broadly diversified and has spun off its consumer health division to focus on higher margin areas. Ongoing litigations, risk, and slower growth are the reason it's not higher, but it's still a foundational piece of the portfolio. This one goes in tier B, and their ongoing litigations will dictate if it goes lower in the future. And last but not least, S&P Global. It flies under the radar, but its business is critical. This is a company investors barely talk about. S&P Global owns S&P indices and provides credit ratings, financial analytics, and data to institutions around the world. The demand for financial data and benchmarks isn't going anywhere, and its high margin, low capital business make it a long-term compounding machine, putting S&P Global in the S tier. And that's the full breakdown of my dividend stock portfolio. Let me know what you think. Would you rank any of these differently? If you enjoyed this breakdown and want to keep following my dividend investing journey, don't forget to hit like and subscribe. Thanks for watching, and I'll see you in the next one.